In a few hours, Australia's property rulebook quietly resets, and most homeowners and renters have no idea what that actually means for their bank balance. The government is selling it as a fairness fix, a tidy tweak to negative gearing and capital gains tax that will magically help first home buyers without really touching prices or rents. But these rule changes are landing on top of already tight rental markets, ongoing housing undersupply, strong migration, and fragile building activity in what was already one of the most stressed housing systems in modern Australian history. This is not just a tax story, it is a housing reset. Not do prices crash 40% tomorrow, but who gets sacrificed so the system keeps limping along? For 3 decades, Australia has run one basic script. Let investors borrow aggressively, bleed cash on paper, write it off against their wages, and bank tax discounted capital gains on the way out. The pitch was simple. You take the risk, the tax system will look after you, and the combination of negative gearing plus a 50% capital gains discount will do the heavy lifting over time. Tonight, that script is being snapped in half for any new investor who wants to buy an established home. And most people scrolling headlines have not actually understood what that means for their suburb, their rent, or their retirement plan. Before this video ends, you will see exactly how this reset shifts pain between investors, renters, and first home buyers. What the banks and Treasury modelling are quietly admitting, and the 3 scenarios almost no one is talking about, including the one that looks most likely for the kind of property you live in right now. To get there, we need to strip the budget spin down to the bare numbers and then follow where the data leads when you bolt those numbers onto an already broken housing system. So let us start with what actually changed tonight, in plain language, not in tax office jargon. Up until budget night, if you bought a rental property and it bled cash, you could use those losses to slam your taxable income down, whether you were a teacher or a surgeon. From 7:30 in the evening on budget night 2026, any investor who buys an established residential property is on borrowed time. They can still offset losses against salary and wage income until 30 June 2027. But from 1 July 2027, those losses are quarantined inside the residential property bucket. You will only be able to use those losses against other residential rental income or against your eventual capital gain on residential property, not against your salary. At the same time, the long-standing 50% capital gains tax discount in its old form is being dismantled for new investments. If you buy after budget night, you no longer automatically get to cut your taxable gain in half forever. Instead, for most assets, the gain will be adjusted for inflation and then taxed as income, with a minimum effective tax rate of 30% on the gain, regardless of how low your other income is. Treasury explainers and bank summaries make it clear that this is a deliberate move to narrow the gap between the tax paid on wages and the tax paid on capital gains. But there is one enormous exemption that changes everything. New builds keep the goodies. If your investment genuinely adds to housing supply, you can still negatively gear it, and you can still choose the existing 50% capital gains discount instead of the new inflation-indexed option. That means 2 people can buy 2 properties on the same street tomorrow, and if one is a brand new unit in a qualifying project and the other is a 30-year-old house, the tax system will reward one and punish the other for the next decade. The promise is simple and seductive. The government says this will cool investor demand for existing stock, open the door for first home buyers, redirect money to new construction, and barely nudge prices or rents. Treasury has even put numbers on it, suggesting the changes might slow house price growth by around 2 percentage points in the short term, modestly reduce investor activity, and push rents up by only about $2 a week on average for median renting households. On paper, that sounds harmless. The data on the ground tells a very different story when you drop these rules onto a market that was already under heavy stress before the budget was even drafted. On paper, this all sounds clever. In practice, when you bolt these changes onto a market that does not have enough homes and is still running vacancy rates well below pre-pandemic averages, the mathematics starts to look very different very quickly. That is where the real reset begins, and to see it you have to follow the data rather than the slogans. Underneath the budget press conference, there are three engines quietly driving this reset, and none of them care about talking points. The first is chronic undersupply colliding with redirected incentives. Independent rental reviews have shown that national rental vacancy rates are sitting around 1.7%. Well below the pre-pandemic decade average of about 3.3%, with rental listings down double digits compared with normal levels. CoreLogic data reported by national media has told the same story since 2023. Rents rose strongly as migration rebounded into a market with a chronic shortage of available properties and tight vacancy rates. At exactly the same time as these tax changes, net migration has been elevated. Household sizes shrank through the pandemic and have only partially normalized, and building completions have struggled under the weight of cost blowouts and builder collapses. The government did not kill property investing tonight. It rewired it with a financial cattle prod that says, if you want tax benefits, stop buying existing homes and go fund new ones. But the pipeline for new housing was already clogged before this reset. Planning systems are slow, labor and materials remain expensive by historical standards, and a long list of builders has already gone to the wall over fixed-price contracts that no longer stack up. The data is already clear that new approvals and commencements have been under pressure, and a tax incentive in the budget papers does not magically bulldoze land, train trades, or reverse cost inflation. The second engine is interest rates, credit, and a mortgage time bomb that is still ticking in the background. Since 2022, the Reserve Bank of Australia has pushed through one of the fastest rate hiking cycles in its modern history, taking the cash rate to around 4.35% by May 2026, after reversing an earlier easing cycle. A significant group of borrowers has already rolled off very low fixed rates onto much higher variable rates, and Bank and Reserve Bank commentary have warned that the full effect of past rate rises will continue to work through household budgets over coming years. The timeline now overlaps almost perfectly with the 1 July 2027 start date for the new negative gearing and capital gains tax rules. That means a lot of highly leveraged investors in established stock are about to lose part of their tax shields at the same moment their repayments have already jumped and any remaining buffers are being tested. The data we already have from past rate cycles is brutally consistent. When repayments jump and incomes do not, something has to give in the household budget. The third engine is the renter's squeeze and what I will call the $2 lie. Treasury modeling in the budget and media summaries suggest these changes might add around $2 a week to rents at the median over time, and that national house price growth might moderate modestly. But the official line is that renters will barely feel a thing. That sits very uneasily with what the data already shows, happening in the rental market even before a single investor has changed strategy because of this budget. When vacancy rates have been sitting well below pre-pandemic averages, when independent rental reviews show national vacancies around 1.7% and rental listings 17% below 5-year norms, and when median rents have risen by more than 40% since late 2020, you cannot pretend pulling investor demand away from existing homes is a free lunch. Fewer investors buying existing homes does not just hurt auction clearance rates. It literally means fewer newly purchased properties enter the long-term rental pool at a time when new construction is already struggling to keep up. In a market already in a rental crisis, Even a small shrinkage in available rental stock can push rents sharply higher because tenants are competing for whatever is left while landlords with surviving properties test how far they can push without losing a tenant. When rental supply shrinks faster than prices fall, renters become the pressure valve for everyone else's policy experiments. The data from independent rental indices, vacancy reports, and the lived experience of anyone trying to find a lease in a capital city all point in the same direction. Tenants were already being squeezed hard before tonight's tax reforms arrived. So if the old rulebook is gone, investors are being pushed into one corner, renters into another, and the supply shortage is still there. What does a massive housing reset actually look like in real life? There are three very different paths from here, and only one of them even vaguely resembles the Hollywood-style crash people keep screaming about on social media. The first path is the silent reset, the one that never produces a single viral chart, but quietly wipes wealth in slow motion. In this scenario, prices do not crash 40 or 50% overnight. Instead, nominal prices in many suburbs grind sideways for years while inflation eats away at their real value. On paper, the median might only edge down a little or even tick up, which is exactly the kind of cosmetic number that lets banks and ministers say everything is orderly. In reality, if inflation runs at 3 or 4% for a decade and your asset goes nowhere, your purchasing power has been hollowed out and your supposedly safe equity has quietly evaporated. Meanwhile, rents keep grinding higher because the fundamental supply problem has not been fixed, and the tax changes have steered investors away from the established stock most renters actually live in. In this path, young buyers are still locked out because the absolute dollar deposits and serviceability tests banks require remain extreme relative to wages, even if the headline price stops exploding. The reset happens through time, not through a screaming front-page crash, and the people who only watch the median house price chart miss the fact that their real wealth has been quietly crushed. Historical data from other countries that lived through long sideways periods shows how easy it is for a society to pretend nothing is wrong while a generation's opportunity is erased. The second path is the renters' revolt, where the pain is not evenly shared, it is pushed downwards. In this version, investors who align themselves with the new rules by backing new build projects keep their tax perks and survive, and owners sitting in established, land-scarce, high-income suburbs with grandfathered negative gearing keep their structures intact. The people who bleed are the renters in outer suburbs and regional centres where supply was already fragile and investor participation was already falling. As fewer investors are willing to buy older houses in average suburbs without tax benefits, those markets see slower investor turnover, fewer new rentals, and more pressure on whatever stock remains. The reset in this path is not a clean crash you can capture in an auction clearance rate chart. It shows up in rent spikes, forced relocations, overcrowding, and rising homelessness and social housing waitlists. It shows up in data on rent arrears, in community sector reports about more families sleeping in cars, and in local stories about tenants having their rent raised 15% because they have nowhere else to go. The property system still works for the people at the top of the ownership tree. The reset becomes a social and political crisis around housing, not a tidy financial one. The third path is the credit event. And this is the one people have in their heads when they click on a thumbnail that says crash. To get a genuine 50% nominal price collapse across broad parts of the country, you typically need something worse than a tax change. You need a credit accident. That means a hard landing in employment that throws large numbers of borrowers out of work, not just a mild uptick in underemployment. It means a true mortgage default wave, where arrears spike and forced sales pick up at a pace that overwhelms the number of willing buyers. It means banks responding not with quiet loan restructures, but with aggressive credit tightening, pulling back maximum loan sizes and serviceability in a way that slams demand into the floor. Is that possible? Yes. If rates stayed higher for longer than expected, if global shocks hit commodity prices and employment, and if political pressure forced banks to retreat faster than they are currently signaling. Is that the base case that Treasury and the major banks are modeling today? No. Their public scenarios point to modest national average price effects from these tax changes, not a system-wide fire sale. And that is exactly why most people misread what this reset actually is. It is not Hollywood. It is a rewiring of who carries the risk and who gets squeezed, inside a market that was already under pressure before a single line of the tax code changed. Regardless of which path plays out, the silent reset, the renters' revolt, or a true credit event, the era we are stepping into after tonight is nothing like the last 20 years of Australian property. The question is not, will there be a reset? The question is, who will pay for it, and who will quietly benefit from everyone else panicking? That is what you need to be clear about before you make your next move. So let us talk about what smart viewers should think about before this reset really bites. And I am going to speak directly to three groups: homeowners with mortgages, investors and renters, or would-be first home buyers. If you already own a home with a mortgage, your biggest risk is not a headline crash. It is cash flow stress that forces you into a bad decision. The Reserve Bank of Australia and the major banks have made it clear that the full impact of earlier rate rises is still working through household budgets, and that many borrowers have only recently moved or are still moving from lower fixed rates to higher variable rates. The experience from past roll-off waves shows that households who test their buffers early and talk to their banks before they are in arrears have far more options than those who wait until the last minute. If your fixed to variable rollover is coming in the next 12 to 24 months, you should be running the numbers now on what your repayments look like under realistic interest rate paths, not just today. Ask yourself, if my income stays flat and my repayments stay elevated for longer than I thought, do I still sleep at night? That is boring, unexciting work, but that is how you avoid being one of the forced sellers that sets the comparable sale everyone else hangs their valuation off. For most owner-occupiers in fundamentally good, well-located homes, panic selling into a thin market because a valuation on paper has dipped is usually worse than absorbing a short-term paper loss while you ride through a reset. The history of long-term compounding is ruthless. In Australia, much of the wealth that has actually stuck came from staying in quality assets through multiple cycles, not from trying to trade every budget night. If you are an investor, especially one holding or considering established stock, your world changed tonight in a way that is not being fully explained on breakfast television. The tax settings now explicitly reward new supply, not trading existing homes. If you are heavily leveraged into older, generic stock in oversupplied corridors, the kind of mass-produced apartments or fringe estate houses that have already struggled for rental demand, you are now the soft target in this reset. Your interest bill is higher, your ability to offset losses against salary is being squeezed after 2027, and your exit options depend on finding another investor who is willing to buy an asset the tax system has just labeled second class. That does not mean property as an asset class is dead. It means the government has rerouted the river of incentives so that it flows through new supply and certain structures, not through the comfortable negative gearing treadmill of the past 30 years. If you are going to stay in the game, you need to be thinking in 10-year horizons, not 2-year flips, and you need to be obsessed with the quality of the underlying land, not just the tax outcome in year one. The data from past reforms and from institutional-grade investors is blunt. The people who survive resets are the ones who own scarce, functional assets in strong income catchments, not the ones who chase the biggest paper deductions. If you are a renter or a would-be first home buyer, you are the person most exposed to short-term pain in almost every version of this reset. Rents were already being ratcheted up across the capitals long before the budget was handed down, and vacancy rates were already punishingly low. The honest truth is that in the next few years, there is a real risk of further rent spikes, more competition for decent stock, and more stories of people being squeezed out of the area they actually work in. The data says this is already happening in parts of the country. It is not theoretical. But that does not mean your only option is to sit and despair. Instead of obsessing over national median charts, track 3 local signals that matter to you. Watch how long listings sit on the market in the specific suburbs you care about. Rising days on market is one of the earliest signs of buyer fatigue. Watch vendor discounting, how far final sale prices are sitting below asking, because that tells you who actually has power in negotiations. And pay close attention to any genuine easing in vacancy rates in your city or region, not just one agent's story. The reset can create entry windows in specific pockets, especially if nervous investors offload marginal assets. But those windows are narrow and highly localized, not a national fire sale where everything is suddenly half price. The Australians who get destroyed in every housing reset are never the ones who saw it coming. They are the ones who believed the headline instead of reading the data. Tonight's changes are not the whole story, but they are the signal that the old game is over. What you do with that information now is the difference between being crushed by this reset or using it to quietly reposition on your own terms while everyone else argues about slogans. If this video helped you see past the spin and into the numbers, tap like so this information reaches people before they sign another contract or lease without understanding the risk. That simple action tells the algorithm this is not just another fear thumbnail. It is a briefing people actually need. Hit subscribe and turn on notifications because I will keep tracking the data and the fallout from this reset so you do not have to live off headlines. And tell me in the comments whether you are a renter, an owner, or an investor, and what you have already seen change in your city since the budget. Your local experience is the data the official reports are always late to pick up. This video is general information only. It is based on publicly available data and commentary as at mid-2026, and it does not take into account your personal circumstances. It is not financial advice, it is not legal advice, and it is not tax advice. Before you make any decision about buying, selling, or investing in property, you should do your own research and speak with a licensed financial advisor, a qualified tax professional, or another registered professional who understands your situation.